Good morning, everyone, and all the doctors. Welcome to our today's session. So, wish you all a very happy National Doctors Day. And today also happens to be, National Financial Freedom Day. So, we are glad that we have come up with a topic and on a very special day. So, thank you all for the service that you are doing towards the society. It's really a hard job, and hats off to all the doctors out here. So without much ado, we'll just start looking at why do we choose a topic which is specifically finance, and that too, why is it special for doctors or medical professionals. So we all know the reasons that a doctor's economic cycle is very different. So the education itself takes a very long time for doctors and medical professionals to get into a mode of earning. So initially, a few years are spent, to practice as junior doctors, and then they go on to look at options whether they should set up their own clinic or should be employed regularly with a hospital, and those kind of things. So in all these juggles, so there's a delay of income. Proper income starts a bit late compared to other people like engineers or common people, any other profession you take. So for doctors, the proper earnings start a bit late, but once it starts, the earnings are quite significant. And because of the lost years initially, with the hard work that they do in their education and their practice, they have lost some enjoyment in life. And then once the earnings start, the tendency is more likely to kind of enjoy life and spend, and not focusing on anything else other than enjoying the work and the benefits they're getting out of their profession and earnings and things like that. So another aspect of why it makes it a little different for financial planning for doctors is that there is no set retirement age for doctors. It depends on as long as you want. As long as you are fit and fine to keep working, you can work as long as you want. So we have seen many doctors who are older than 70, 75 years, up to 80 years, and still practicing in their own hospitals and things like that. So the income keeps coming quite for a long period of time. So that is also another aspect where planning or looking at the financial aspects becomes important. So, and what happens is the realization, with the kind of interactions we have had with doctors. I have a couple of doctors in my family also. We have some common friends who are doctors, and I also advise doctors. Doctors are my clients as well. So during all these interactions, a typical understanding is that. So normally, when do you realize that you need to take control of your finances, or when is the realization comes that yes, I have to look into planning for my retirement, planning for making my money work for me, or put it into investment avenues which can do better for me. So that realization comes a bit late in doctor's profession, usually around the age of 40 years. So that is something which is a delayed action, first of all, and then there is lesser time to plan for things. And there's a lot of planning and subjective or customization required when it comes to the things. So another aspect which makes it different for doctors' financials is, because of the lack of time and because of lack of a minimal understanding. I wouldn't say lack of knowledge, with minimal knowledge about other financial avenues. The easiest way is to park money in FDs or gold or real estate. So a lot of doctors tend to do more into real estate and FDs. Because they find that is the safest avenues without having to do much of a research. You are protecting your capital and you're earning a return there. So that is one. So what happens? There's nothing wrong in doing that, but over a period of time, that becomes like a over concentration risk that one has. So we'll come to that, like what happens if there is a lot of real estate, and what happens because of this over concentration risk. So basically, these are some of the challenges or the parameters that makes it different for financial planning for doctors. So we have to, as advisors, we come to know that we have to pay more attention to cash flow management. That is because once there's education loan in some cases where doctors have taken big education loans, and the first priority becomes repaying those loans when they start off, earning. So that becomes a priority. And after that, maybe they are employed in 2 or 3 places as consultants, or they're full-time employed with consultant, plus they also do their own practice. So there's a combination of incomes that is coming. So and there is combination of expenses also, personal and work related. So how do we manage these cash flows? What is the surplus end of the day? What do we do with this surplus? How to channelize, how to differentiate personal and professional finances? So those are the things. Then comes the goals planning. So like I said, because there is delay and because the aspects are a little different, somehow the finances or goals planning or goal setting takes a backseat. So there has to be a clarity of where we are doing and what we are doing, why we are doing, and things like that. So just investing or just saving is like shooting in the dark. We don't know where we are heading and why we are doing, right? So these are some of the things. Postponement. There is in a lot of cases, like I said, because of the realization that it comes a bit later. So there is postponement. So we have to somewhere consolidate and figure out and create a roadmap to streamline things. So that is why we are doing this session today, like to help you equip with, if you're doing it on your own, how do you equip and how do you measure your financial health? What are the parameters you should look at? What are the red flags that you should take note of and keep assessing from time to time, because valuations and assets keep increasing or decreasing from time to time. So you need to be a little more careful. So, and then once we are into, let's take, some action and start looking at things. The big question is, where do I start? So most of the times, I understand with some conversations that I've had with medical professionals and doctor clients, is that the awareness is very less as to where to start. Looking at sorting out financial management, personal finances or business finances. So what happens is, in many cases, if there is a private practice, medical practice, there is a mix of, somewhere the finances are mixed, both personal and professional. So then the priority becomes to first segregate it. So how do we do that is, you have to prepare a good financial plan. So a financial plan is like a financial health check, like, it first level diagnosis of where do you stand today. So it helps you understand. So what are the parameters within a financial plan you should look at is, first your risk management, like how much emergency fund you should be looking at maintaining at all time. Insurance, are you having different types of insurance, including your indemnity, professional indemnity insurance, your life insurance, health insurance, and all of these risk management tools and techniques. And then you should also consider having a goal based approach to your investments and savings. So it all starts with having a good financial plan. These days there are a lot of tools available online where you can find a good financial planning app or a portal where you can put your numbers and things, ideas, and a plan is prepared for you. Either you can take the help of that, or if you want a trusted advisor, you can look for consulting a SEBI registered investment expert. So when it comes to risk management, it becomes very important to assess what are your specific risks which come to a doctor's profession and personal finances. So professionally, what are the risks is that doctors, in many cases, they face violence. If there's a lawsuit or something has gone wrong, and the patient's family, tends to express their disconcern or concerns in a different way sometimes, and that ends up in litigations or things like that, medical malpractice claims, and things like that. So that is one of the biggest professional risks that doctors face. So we have to consider having enough indemnity insurance if such cases are there. So I have dealt with this topic separately in my webinar, which was titled as Asset Protection for Doctors. So I've dealt with much more in detail, like what could be your professional risks and how to go about mitigating those risks. What are the ideas or avenues available to take care of these. So you can visit our YouTube channel, Right Horizons, and you can find my webinar on this particular topic. But here today I'll be touching upon very briefly. So if any specific queries are there, I'd like to take it at the end. Then another professional risk is that we all know doctors face patients directly. So there's a risk of disease, physical and emotional breakdown, because it's a stressful job at the end of the day. It's very stressful. There are long working hours, and if there's an emergency, you have to be out there even if you are tired. So all those elements add to some kind of a personal risk as well, personal and professional. So if you're a doctor who is practicing and who uses online tools for reviews and things like that, so it becomes important for you to also maintain a online reputation. So if there are negative feedbacks, what do you do about these feedbacks? You can hire a person who can monitor this and looks after this and takes care of resolution from regularly. If you are a busy doctor, then you should take help from professionals who can manage your online presence. So those are some of the things which I have answered in the other webinar. The personal risks are again risks to your assets, wealth, and property. If you have a private practice, then protecting your business property, your equipments, the health and safety of your employees, staff, that also becomes a risk which has to be dealt with. Creditors, if there's a loan for business setup, then how do you handle these creditors, and what is the plan to eventually manage the loan within a short period of time? You want to repay the loan, so what you can do about it? So these are the elements you should first try to address when you start off with a financial plan. Another aspect of personal risk is, a lot of the times there is there could be a case of divorce or a separation. So how do you deal with that? So these are some of the elements which not only have a risk on you, but your family and your dependents as well. So when you start financial planning, these are some of the important risks that you need to cover. Then asset protection for doctors, I've already mentioned, like, why is it important? So what does it do is, it will safeguard your wealth from unnecessary financial threats. It will minimize your exposure to potential lawsuits. Your personal liability is minimized, basically, so that then your personal assets and your personal goals, your children's goals, are safeguarded. If something happens, then there are tools and techniques which will take care of those aspects if there is a case like that. So asset protection becomes an important goal in one doctor's financial planning journey. So what does financial planning do is, it helps you set up the runway. So for a flight, there is so much of preparation that goes before it takes off, right? Starting from the engine, from the crew, from the internal and external, the weather, and then the runway, the path that it needs to take off. So similarly, a financial plan also prepares for the worst case scenario. So it is always said that a good financial plan is the one which not only helps you invest and earn returns or maximizes your wealth or anything like that. It also understands your emotional well-being, emotional and financial well-being, and how to strike the right balance between these two elements, and how to prepare you for the worst. What are the likelihood of things going wrong, and how do you protect yourself and your dependents with this? So the financial planning helps you set a proper runway. Okay, it helps you come up with a lot of scenarios, like, what if I do this today? What if I don't do this today? How my things are looking 10 years down the line, 15 years down the line, right? So starting with a financial plan is a good idea. So it is important for everyone, actually. If it is somebody who is starting to look into financial aspects, we always recommend to start with a good financial plan, and more so for doctors, because of all the things that we have discussed initially, because of the delay, because of sudden start of income, and there's a lot of growth potential also in the incomes. So diverting that, channelizing that to the best possible way to optimize the resources is important. So let's look at this video to understand what are the 5 steps for financial planning.
For building a house, it is essential to create a perfect blueprint for the same. Similarly, for building a wealth for you and your family, requires you to build a financial blueprint also known as financial planning. Here are the 5 steps of building successful financial plan. Planning for uncertainty. First step is to protect yourself from uncertainty by buying required insurance policies to ensure that any uncertainty do not eat up your savings. Build contingency corpus. Second step is to build contingency corpus up to 6 to 9 months of your monthly expenses. This will protect your long-term investments from the contingencies like loss of job or slowdown in business. Set financial goals. Third step is to set financial goals and find out when and how much money would you require to achieve these financial goals. Create portfolio. Fourth step is to select right asset class and product to invest and to achieve your financial goals based on the time horizon and your risk appetite. Portfolio review. Fifth step is to review your portfolio periodically and do the necessary adjustments into it based on the remaining time period to achieve each goal. To create a financial plan.
So these are the, I hope the video was clear and you were able to understand. So it always begins with understanding your risks and how to protect your wealth, your family, and your goals with those risks, right? So to talk about what are the important elements of a financial plan, you should understand that after risk management. So you should also be focusing on setting up your financial objectives. Like let's say you want to buy a car or you want to buy a house, you want to go on vacation, you want to plan for your child's education, whether India or abroad. How much should I be having like a corpus, whether we are going to fund it with our personal resources or whether we go for a loan partially or fully. So those aspects. So what are your financial objectives? Financial objectives can also be capital protection, whether I should be what is my risk appetite basically, right? Should I take risk, should I not take risk, should I protect? Capital protection, is capital protection my ultimate objective, or I'm okay to take a little bit of a chance and look at a little bit higher risk? So all that, it depends on your own personality, your own financial situation, and your own financial goals. What do you want at the end of the thing? So lifestyle management. As doctors, you have a very good lifestyle. So how do you manage that? Managing lifestyle and upgrading your lifestyle becomes very important. And how do you manage that within all the resources that you have? So are your resources and is the growth path enough to take care of your lifestyle needs? And how do you do your tax planning? So are you saving enough taxes? And do I have the right investment avenues, or do I have the right mechanism to save taxes for me? So that kind of assessment is very important. Then your risk management, your insurances. Then comes the investment part. So where do I invest? Why do I invest? And how much do I invest? In which avenues do I invest? So investment planning is just a small part of financial planning. So financial planning is a much more holistic approach, which gives a 360-degree view of your entire financial landscape, right? And then how do you look at your retirement planning? So what happens initially when we are young, we tend to ignore the idea of retirement planning. We always feel that we have a lot of time. It's too early to think of it. But trust me, starting early is the best way to plan for your retirement. So I'll show you some of these slides, which will maybe enlighten a little more. And then after all this, after your goals are met, after this, everything is taken care, there's still scope for wealth management. Then comes your thing of aspirational goals to give back to the society, or what do you want to leave back as a legacy to your family members, to your children. Then comes the estate planning part. So this is the whole horizon of financial planning. So most of the times when the question comes, how do I start and how do I save? So this is a common thumb rule. What happens practically is when we get our incomes, the first thing that we do is our basic needs and basic expenses and EMIs are taken care. Immediately after that, there has to be an automated process to also capture some savings. Some automated savings which are silently building wealth at the back, right? So the saving has to be there as a part of your overall planning. The best way to go about is to create a budget. Budget also helps you understand where your money is going, whether that's unnecessary. Can we look at, minimizing that portion, or can we look at, optimizing, such expenses? And then comes how do you save and how do you invest. So why should you invest? So you might ask, I'm happy with, keeping my money in my savings account or FD. So why should I invest? So typical answer can be high returns, right? So let's see. So earnings gives you resource in hands to spend, right? And spendings takes away cash out from your hand. Savings will tell you to spend less and earn more. That is, set something aside. Saving always means setting something aside. What does investing do? Is investing helps us to understand that it is important to put it aside somewhere for a longer term so that it is earning something better than savings account. Okay. So earning your income, your earning more incomes, or improvising or maximizing your incomes is the first step towards financial independence. Okay. What comes next is your investments. Why do we invest? Is to make your money work for you rather than you working for the money. How do you do that down the line? So you do, nobody wants to keep earning till the end, just for the sake of running a household or meeting the day-to-day expenses, right? So when we are young, we have to put in place some mechanism or strategies which are making our money work for us in the future. So that is where investing becomes very essential. So a combination of things that we put across where we invest becomes our investment portfolio, right? So here it also becomes important, especially for doctors, is that there is a cost associated with every delay that you do today, right? So just let's just take the simple example. There are two people of the same age. Okay, one of them starts investing at the age of 25. The other starts investing at the age of 35. Let's say this is for the retirement itself, right? So the person who starts early starts small. The person who starts late starts to invest big. So at the end, if you see, there is a big difference in the accumulated amount. So this is the power of compounding. So we should all understand that the sooner we start investing, sooner we start putting our money to work for us, the better it is. So we have better control on the things. And less is required out of our commitments today if it is done a few years later. So a few years later, I might be required to spend to save much more than what I'm supposed to today. And then because of the shortage or because of the lost time, my focus also shifts on earning higher returns, achieving some better results in a short period of time. Then the whole thing takes a different turn, and things might turn up not so good. So start today. So today is the thing. So let's take a small look at this video. This is very interesting. The power of compounding.
If you want to go around the earth and start with 100 meters on the first day and double the distance every day, how long do you think it will take? 1 year? 10 years? Let's find out. Within 19 days, you would have covered 39,321 kilometers, while the equatorial circumference of Earth is about 40,075 kilometers. You would have traveled around the world in less than 20 days. But what if you stopped after 10 days? You would have hardly covered a little less than 77 kilometers. This is the power of compounding. Power of compounding can help you to create a great wealth as well. How to leverage the power of compounding for maximum benefit? Start early and invest regularly. Nisha invests rupees 5,000 every month since the age of 25, while Nilesh invests rupees 7,000 every month since the age of 35. By the age of 60, both would have invested 21 lakh rupees. Assuming a return of 12%, Nisha will accumulate 2.75 crore rupees, while Nilesh will get only 1.19 crore rupees, which is 59% lesser than Nisha's wealth. This is why starting early is important. To create a wealth, start an SIP in equity.
So, so you have seen why it becomes important, to start early. So the more time you give for your money, the better it is, the better corpus, the sooner you'll be able to have a tension-free, a peaceful life. So after a certain point of time, working regularly should become an option rather than a necessity, right? So the same example I'd like to show here. Let's say there's Dr. Gaurav, who is 35 right now, and he lives with his family in Indore, and his child is studying in class 4. He is expected to look at retiring at age 60, and the life expectancy is 85. These are his basic, basic needs, regular expenses, and we have considered an inflation of 7%, and post-retirement return is at 8%. So after retirement, we tend to invest less in equity. So we look at more safer asset classes. That's why we have considered a 8%. So with all of these expenses, so if I extrapolate his requirement into the future at 60 years, he'll need a corpus of 8.7 crores to live the rest of his life, that is another 25 years. So let's look at, what he says is he wants to buy a car. Okay, so he wants to buy a car, and that's why he's thinking if he should delay his retirement savings by 10 years. So you can see with this example, with the different required rate of returns, if he starts investing at 35, the per month required amount is very less. The more he delays, the amount keeps becoming bigger and bigger to accumulate this corpus at the end of 60 years. So this is another example. So the bottom line is to start off right away. Okay. So now let's come to the very important aspect of today's discussion. So let's say now in your profession, what is the protocol that a doctor follows when a patient comes to you? So it usually starts with a diagnosis of a patient's history and assessment, first level assessment, and then comes and then with different tests and things, we come to know that the person needs some kind of a specific or customized medication and things like that. Same applies to portfolio, and same applies to personal finances also. Now, how do you diagnose your financial situation? Please give a thought to this. How do you diagnose your financial situation? I'll equip you with some of the important ratios which will help you understand where you stand today and what you need to do. So, understanding of financial health, what are the symptoms? How do you gauge those symptoms in your financial health? So, these are some of the important ratios that you can take help of to understand where you stand today. The first and foremost, like I always stressed when I started about financial planning, is understanding the risk part. So first thing is your emergency fund. So how much emergency fund do you have at present? How do you calculate that? Is you have to calculate the liquidity ratio. So how do you calculate that? Is consider all the amount that you have in liquid cash or liquid mutual funds or liquid, which is near cash item. Divide that with your monthly expenses. Okay, so you should get a number in between 6 to 8. So that means you have 6 to 8 months of expenses plus EMIs in your liquid assets. Now, at any point of time, you should ensure that this amount is kept separately as an emergency fund. At any point of time, this amount is always set aside, and every year or every once in 2 years, this proportion has to go up at least by 10 to 15%. So that is the first one. Second one is your savings ratio. So I told that the first step of financial planning starts with the risk analysis, the contingency management, and then comes how do you save, right? So what are your savings at present? How much you are saving today? Savings divided by your gross income gives you that ratio. If your ratio is more than 30%, then you're very good. So you're doing an excellent job. So if your ratio is coming to less than 10 or 15%, then you should pump it up, do something, crunch your expenses and push it to 25 to 30%. So savings, when I say savings here, means your regular savings that are happening, whether it is a saving into your LIC policy, whether it is a saving into your SIPs, whether it is your public provident fund, Sukanya Samriddhi, all of this, right? on an annual basis or on a monthly basis how much you are contributing. On an annual basis, it has to be more than 30%. Next one is your debt to asset ratio. What is the meaning of debt? Debt is nothing but your loans, personal loan, car loan, home loan, credit card loan. So all kinds of loans, what is their ratio to your total assets? So total liabilities or total loans divided by total assets gives you this ratio. The lower this ratio, the better it is. That means you have more of assets and less of loans. So if ideally, if you ask me a number per se, it is anything more than 40-50% is a warning sign. If you have loans and liabilities more than 40% of your total assets, it is a red flag. More than 50%, it's a danger. You should look at ways of minimizing this ratio. Then comes your debt servicing ratio, that is your EMIs, right? What is the proportion of your EMIs to your total income? So your short-term liabilities, that is your EMIs, divided by your total income gives this ratio. So you should always spend around 20-30% in EMIs. The rest you will need. See, when we say the 50-30-20 rule, right? The first 50% should go in your basic needs. Your regular expenses plus EMIs should form 50% of your income. The next 30% of your income should go towards committed savings, committed regular systematic savings. Then the last 20% we should look at lifestyle spending, right? Going out, clubs, meeting friends, dining out, movies, sports, and things like that. So when we look at that ratio, it's very clear that if your EMIs itself are forming 20-30% of your income, then you have very less scope for regular expenses and very less scope for savings also. So always keep it at a lower. Next comes your inflation hedge ratio. This is very important. So this is related to your investment rate of return. What return are you getting on your investments, whether it is mutual funds, whether it is shares, whether it is your FDs, your real estate investments, your gold investments? What is the kind of return you're getting? Is it when you adjust it to inflation, what is the real rate of return? So we ideally say that always investment return minus the inflation rate should be more than 2%. So the gap between the two should be more than 2%, which is a desirable situation. So please go back and check what is the return you're getting on your investments and whether it is helping you beat inflation. Next comes your financial assets ratio. Now, what are financial assets? Any assets which are easily convertible into cash, which do not have a very long lock-in period, right? Which can be sold and immediately in 2-3 days or in a week's time, you have cash in hand. So those are your financial assets, right? So financial assets divided by total assets will give you the financial assets ratio. In total assets, you need to consider financial assets, your real estate, your gold, and any other asset that you think is an investment for you. So total financial assets divided by total assets will give you this ratio. At any point of time, your financial assets should have a higher percentage. That is because you cannot plan goals with locking your investments in real estate. Let's say you have invested in real estate for your kids' education. Then when the child reaches this education age, it becomes difficult to find a buyer at the right time. So the process has to start 2-3 years early, right, to liquidate this particular property and then invest it or do something to plan for the education. So this is just an example. So, but alternatively, if you have financial assets, okay, let's say it's a FD only, FD, which is very liquid. So it is available whenever you want. And you can plan other goals also with financial assets, not only long term, short term, medium term. So all assets need to be, all the goals need to be aligned with financial assets rather than real assets. Real assets can be looked at more from a passive income strategy rather than for goals planning, right? So ideal or desirable ratio is more than 60% one should have in financial assets, and more so when one is nearing retirement. By 50-55 years of age, you should have more into financial assets, because then you don't have to depend on anybody or anything for your retirement withdrawals. Then comes your last but very important, your life insurance coverage ratio. How much? This is a common question, we get asked. How much life insurance should I have? So this will give you the answer. What is your total net worth today? Net worth, how do you arrive at the net worth is total assets minus total liabilities. That is your net worth. So that net worth plus your existing life insurance divided by your post-tax salary. Okay, so here more than 10 is better. More than 10 number is a good ratio. So that is the kind of coverage you should always have. If there is a shortfall, you should think of alternative ways. Either you should set aside more financial assets to take care of this insurance part, or if there is a scope to add more insurance, you should add pure term insurances to your insurance coverage ratio. So those are the things. So this is how you can assess your financial health. So these are the symptoms. So here you will understand where you need to focus and what changes need to be made. And then subsequently comes what is the medication for these. So alongside, we should also look at some of the common mistakes, that people make when it comes to money management. First thing is uh, assessment of risk profile. So what is your risk profile? It just comes out of a thing like, just without any assessment or without any background check. People say I can take high risk, I can take moderately high risk. Without even proper assessment, they say no, I don't want to take risk, right? So assessing your risk profile is very important. And then once you assess your risk profile, not following an asset allocation is important. Now, what is asset allocation? Asset allocation is a portfolio design which helps you understand how much of money you should put in which basket. We all know that we shouldn't put all our eggs in one basket. Some portion has to go in market linked investments, some portion has to go in fixed income investments, some portion has to sit there in the savings bank account, right? That is also important. Some portion has to go in non-correlated investments like gold, debt income. So those kind of things. So asset allocation, without following an asset allocation as per your age and as per your financial situation is a big mistake. And these are some of the symptoms or pointers for you to understand that yes, whatever I'm doing today is not right. I need to take some control of it. Right? Then comes your over concentration and over diversification element. So if you're doing one particular investment, just because you have a liking for it, doesn't mean that it is always right. So you have to understand what are the smart ways of doing. So over putting your investments in one kind of investment is also not good, and over diversification is also not good. Recently, I had to analyze the portfolio of one of the doctors. So over a period of time, there are lot of mutual fund folios. Different. You name the mutual fund, it is there in the portfolio. About 40-45 mutual funds are there in the portfolio. It's quite a big portfolio. So this is like over diversification, right? And even the stock portfolio had 50-60 stocks or maybe 70 stocks, right? So this is like over diversification. You need to follow a focused approach. You need to know where to strike the right balance, right? So a good 15 to 20 or max 25 stocks which are nicely diversified into different sectors, into different market capitalization, with proper growth elements, earnings per share. So all these assessments are done, and a quite focused 15, 20, 25 stocks ka portfolio is good for you. Same with mutual funds also. There are different categories of mutual funds: large cap, mid cap, small cap. Now, in every category, you have 4 to 5 funds or 10 funds. It doesn't make sense. So then your entire performance is, becomes diluted. And then your focus also shifts from looking at investing or looking at saving to understanding the different funds, why this fund is performing, why this fund is not performing. So if you have a long list of 40-45 funds, imagine the kind of time you're going to put in that, and over a period of time how that is going to impact your finances. So these are some of the things. Then timing the market. So we don't know exactly, nobody knows where the markets are, how the markets are going to behave, right? So one should never go to time the markets and invest or exit or things like that. What we have to do is a tactical approach. There are two approaches to investing. One is the tactical approach, and one is the standard long term approach. So the long term objective has to be something at the base of it. And tactical changes should come because of subjective reasons. So those are some of the things we should look at. Whenever see, when it comes to timing the market, there is also a situation or questions we get asked as advisors is like, the markets are at all time high, should I stop my SIPs now? The markets are not doing very well, should I stop my SIPs now? It doesn't work like that. So you have to be systematic, you have to be consistent, and you have to be disciplined. Where in the short term the markets behave in a volatile manner, we all know that. So what helps your portfolio is your consistent and disciplined behavior. So let the SIPs go as it is, as scheduled. See, it is like this. Once we take a train ticket or a bus ticket, and we get inside the bus, we don't get down until and unless we have reached our destination, right? The same thing applies to your investments also. Once you have started the journey, just because you are given that option to come out and get in at any point of time doesn't mean you have to do so. So once you have started investing, let's say for your child's education, which is about 7 years away, so don't look at don't think about anything, just consistently invest. Keep your SIPs going for the next 6 years at least. In the 6th year you should look at taking out and setting it aside in a safer asset class, so that there is protection of that capital. So in the next year, the child is going for the college or something, and you can use this money. So those are the things. Last but very important is following social media advice. Just because it is free, it doesn't mean that it is an expert advice. You should always believe in following expert advice. Who are the experts you can trust? For financial advice is, you should look for credentials. Credentials like SEBI certified RIA, who is a registered investment advisor. So they a chartered wealth manager, a CFP, a CWM, a chartered wealth manager. Who is a CFP? A CFP is a chartered financial planner. So these are the credentials one should look at. A CFA, a chartered financial analyst. These are the experts who are dealing day in and day out with personal finances and the investments avenues that are there in the market for personal finances. So these are the experts who work day in day out. They have the best knowledge, what works, what doesn't work, and you should look at like that. So if you're somebody who is a DIY, then you should look at following blogs or content which is coming from these professionals, right? So follow the real expert advice and not just random social media advice that keeps coming, right? So these are the typical asset allocation, how it is done. So ideally we say your 100 minus your age, you should look at investing in equities. So the younger you are, the more equity investments you can have. As you grow older, you tend to adjust your equity portfolio and reduce your equity exposure and do more in debt. So now, how do you assess your risk profile? So I said that you should assess your risk profile, right? So how do you assess that? So there are a lot of risk profile questionnaires that are available online. You can take help of that. Some portals also give you the scorecard or the result also, like your risk profile is moderate, your risk profile is aggressive, and things like that. So you can take help of that. What are the typical questions that they ask is your income source stable? How much time can you stay invested? How far or near are your goals? Are you comfortable to volatility in your portfolio? To what extent can you tolerate seeing your money fluctuate, right? So these are some of the insights into your attitude towards risk. So this will help you understand like what is the risk that you should be taking. Or this risk assessment is also done by your advisor, any advisor for that matter. Even me, I assess my client when we meet up for the first time. This is what we do first. We try to answer a questionnaire and understand where the client is coming from. This also gives a lot of insight into what the client's experience has been into investing or into managing his or her personal finances till today. What are those pain points, right? So then you should also try and answer these two important questions, the last two. What will you do if you have abundant wealth today? So this gives us insight into what you want to do as an aspiration or giving back to the society, right? And the last one also helps you assess a situation. Like what will be your approach if you have only a few months left to live, right? What comes to your mind? What will change? What will not change? What will you regret? What becomes your priority if this is the case, right? So this gives you a better understanding of what do you want as a financial objective and what should your focus be. So these are the three components which together form your risk profile. The first one is your risk tolerance. So how much prepared are you mentally to take that downside movement? Are you okay? Are you not okay? Are you very uncomfortable, or are you a little comfortable? Right? So that is the risk tolerance. Next is your risk appetite. Like how much is there a financial backup for you so that you're taking a risk? Like you're risking your money into something where even if it fluctuates or even if it loses value, it will not impact your other aspects of your finances. So is there a backup like that? So that is your risk appetite. So then comes your requirement. So risk that must be taken to reach the goal. So what type of risk you are required to take today to reach your goal? So that is your risk requirement. So these three components put together gives you a risk profile. So the question is, should typically try and factor in or touch upon these aspects of a person. So these are the different kinds of risk profile. Moderate is a balanced one where um, uh, where the person is okay with both risk also and non-risk also. So he or she wants to strike a right balance. So that is moderate. So on the other end is moderately conservative and conservative, that they are not at all willing to take risk and they don't have the appetite to take risk. On the other hand side, we have moderately aggressive and aggressive, where they have backup, they have good risk appetite, they are able to take risk and look at riskier investment opportunities. This all comes also as a factor of age, what age you are in and what are your financial goals and responsibilities towards your family. So all these four factors combining together will give you the risk profile. So let me discuss a small case study. So uh, yeah. So recently I did a financial planning for a doctor. So he and his family have moved to India recently, about a year and a half ago, and they had approached us. So long back, I had done a small financial planning exercise for the family way back in 2017 or something. And at that point of time, they were in UK, and recently they moved to India for good. So that means they're going to continue staying here. The kids have started going to school. So they have two daughters. So what was the situation was, there was about a good number of assets, about three crores, upwards of 3 crores of financial assets, not anything else. Financial assets are only upwards of 3 crores. So by looking at that number, one can say that yes, I have enough to take care of my goals. If I put this to high risk investments, I will be able to take care of anything that will come in my way, whether it is kids education, their marriage. It's a typical understanding. Anybody in this place will feel that yes, I have enough, and I have backup also with other things, my employment, my wife's employment, my other properties, my inheritances. Okay, so this is good enough for me. So then the focus was more towards that, like if I put this at a high yielding return yielding place, my things will be taken care. But what was missing was, you can see here these aspects: risk management. So what if something happens to you today? What is the risk your wife and children have? Okay, and is it taken care? So those elements had to be touched upon. Then monthly surplus. So then when we did an income expense analysis, we found out that there was unnecessary expenditure on an annual basis. So how do we tackle that, and how do we bring in a disciplined approach to a family's budget? So managing the surplus, how do we do that? So assessing the future needs. Of course, we have about 3 crores plus worth of assets today. But when we factor in inflation, whether this, what is the amount that I need for my retirement? What is the amount that I need for my first daughter's education? What is the amount that I need for my second daughter's education? Was that important or not to assess? Okay, if I put this to a high yielding return, yes, will it meet my needs at that point of time? So that assessment was missing. So we did that exercise. Then scientific asset allocation. So here everything was like, linked to more of it, 70-80% was linked to equity markets. So then what was the scientific asset allocation? So we looked at that. I'll come up with a few slides later which shows negative correlated products, why they are important. Okay. So we drafted a financial plan to create a goal-based portfolio. We first dealt with minimizing the life insurance, health insurance, emergency fund, and then look at other avenues where we could hedge the portfolio. What can be one of the items in the portfolio which can take care of passive income at a future point of time? So, and how can all of this be made tax efficient? So, what was the value we created was there was, a good amount of what do you say, 4 to 5 good discussions that happened, and then the realization was that yes, by doing all this exercise, yes, I have a peace of mind. I can visualize what's going to happen. What's, if I do this, what's going to happen? If I don't do this, what's going to happen? So that kind of a detailed, detailed approach the financial plan was able to give. A better clarity, a better direction was set. So as per the risk profiles, so this is typically, the mix of different asset classes that we say. This is like, you can consider this like a ballpark number. Somewhere around these numbers you should look at. If you're a low risk profile, if you're a moderately low, or if you're a moderate risk profile person, moderately high and high. So the returns that you should expect is somewhere in this range. So like I was mentioning, risk adjusted return is more important than just high returns. Inflation adjusted returns are more important than just high returns, right? So those are the things. So there's one small video I'd like to play.
In a multilingual country like India, cricket is a common language 1.3 billion people speak. But do you know, this most revered sport in India has many similarities with investments. Let us have a look. Can you imagine a team of only batsmen? Never, right? We need a perfect blend of batsmen, bowlers, and fielders to win the match. Similarly, to succeed in the game of investment, diversification is the only winning strategy. Just like a balanced team, we need a balanced portfolio to give us better returns. We can't hit the boundary on every delivery. Singles are just as important as boundaries. Similarly, we should invest in debt and equity. Equity provides us high returns when the market is good, and debt provides us consistent returns when the market is tight. Interesting, isn't it? Based on time, there are 3 different formats of cricket, and we select players based on their track record for each format. Similarly, we have different investment horizons, whether short or long term. We must select funds according to our goals only. Lastly, just like a captain is necessary to lead the team, similarly, we should have a professional to lead and guide us throughout the game to ensure the suitability of products we buy. So, we hope you will play this game of investment pretty well now and win the World Cup of your dreams. For more info.
So like that. So just like a team of cricket has different strengths and different kinds of players, so it is important to have different kinds of investments also. Basically, to take care of diversification, to preserve your wealth, to meet your financial goals, for emergencies, and to create a passive income. At the end of the day, all of this should also be tax efficient. So I was saying, timing the market is not the right approach. So what matters is your time in the market. So the markets go in cycles, right? So every business, every economy has these cycles. What goes up has to come down, kind of a logic. So usually what happens is at this point of time, people feel the greed to buy, and so in the short term there will be lot of volatility. But once any market has reached a peak, then there tends to be a correction happening. There tends to be a fall happening in the market. So at this point of time is what happens is whoever has bought here feels the pinch and tends to come out of the investment at this point of time, rather than see it should be the other way. So at this point of time one should have invested, and at this point of time one should have exited ideally, but we don't know how the markets behave, right? So usually what happens, once the markets have reached the peak and they come down a little bit, then they go up, then they come down, and suddenly there's a deep fall. So anything can happen, so it is impossible to time the markets perfectly. So like I was saying, always have a disciplined approach. So yeah, another important thing is why we should have alternative investments, like complementary to contrary to equity investments is debt, gold, and any other alternative investments which are negatively correlated to equity, is because of this scenario. So what if the markets, we know that markets behave like this, right? Ups and downs are always there. What if our goal sometime comes here in 2020? That is what happened. People who wanted to pull out from their equity investments for their retirement expenses, which had just started in 2019-20, they were feeling the pinch. And people who did not have a well diversified portfolio felt a lot of trouble at that point of time, because equity markets were not doing good, and pulling out for day-to-day expenses from this portfolio was not at all advisable. But still they had to do it as a part of distress selling, because they didn't have any other means. So what happens at this in a situation like this, if someone had a gold portfolio, liquid a digital gold portfolio, or a debt mutual fund portfolio, or something into fixed income, so those things were doing quite well at this point of time. So those could have been the means where he or she could have pulled out from. So at any point of time, it is always important to have that asset allocation, which not only caters to the upside, but also when when the markets are not doing well. So it becomes important to have negative correlated or products or investments which are in the which move in the opposite direction, to have in the portfolio. Mr. Ray Dalio, who is a great investor, and he owns his own hedge fund. He's an American-based investor. So he has written a book. In that, he shows that if you have products of if you have a portfolio which has and products in it which are zero correlated, then your chances of losing out. It's the other way. So if your investments are negatively correlated, that means they have a zero correlation, then your chances of probability of losing money is much lesser, and your risk return ratio is much higher. As you move up and you see lesser, more related products, more correlated products into the portfolio, it becomes the other way around. So the probability of losing money is more, and your risk return ratio is less. So always have some avenues in your portfolio which are moving in the opposite direction to your equities, right? So having a good amount of gold, having good amount of fixed income, having good amount of debt in the portfolio is important. So when and why do you high returns? There are three aspects, or three ways of looking at it. One is when you have lesser years in hand, then your focus will be on earning more returns in shorter period of time. Second aspect of it is when you have less savings in hand, right? With whatever you are able to save, the required rate of return becomes has to be more, so that it has to match the need that that you want to have in the given years. So it's like that. So not always high returns should be the focus. It depends from situation to situation. Now, so we have seen all the aspects of a financial plan. So usually there's a misconception. A lot of people think that a financial plan is just investments planning, but it is not so. Financial planning deals with all the aspects like we saw. One important thing is managing your emotion and behavior. So as advisors, it is an important task to handle our clients' emotions also. If you're you're doing things on your own, please read books which enlightens on investors' behavioral management, and you can have some quick videos also, right? So, what do financial advisors really do? So, most of the times, it is misconceived that it's investment advisors just advise on investments and insurance, but it is not so. That is only the tip of the iceberg that one is saying. So, there's a lot of background work and a deep dive analysis that goes like risk management, your cash flow analysis. What are your life goals? What do you do about your retirement planning? How do you adjust inflation? So all kinds of, lot of elements are there which are associated with a good financial plan. A financial advisor helps you do that. So now, when should you approach a financial advisor? So a lot of people are quite successful doing it on their own because they have that kind of a time to spend. They have the tools, to do that kind of an exercise for them. But in case one has to look at, why do I need a professional advisor? So you can look at some of the parameters like this. So your financial affairs, you feel that your financial affairs are disorganized. You need, somebody to take care of it and organize it for you. Or when you feel you're not able to commit time for your finances, you're not able to give that time to review, to take those actions in your, thing, to review your goals, how your investments are aligned to your goals, whether they're going as per the plan, they're not going as per the plan. If you're not able to spend time for that, then you should take a professional help. When the important milestone events are coming up, and you feel that you're less prepared for them, you're not seeing the desired results from your investments, from your finances that you expected when you started. So that is when you should seek a professional help, at least for a one sitting or a one time exercise kind of a thing, and to understand what is happening is, how you can take corrective actions when markets are doing well but your portfolio is not doing well, right? So that is another sign where you should take a professional help. If you have not planned for your retirement, or when your emotions are leading your way, right? So these are some of the things which should help you understand when you should take or why you should take a professional advice. So we are at the end of this session. So it is very important to understand that this pyramid is very important. The protection, the risk protection, the risk management is at the foundation of all of this. Then comes your effective, disciplined, and consistent savings. And then comes your growth path, your risk-taking ability, right? And then your financial independence or financial freedom. So this is the bottom line of all that we have discussed. So what are the mistakes doctors must avoid is failing to act. So delaying things, like, let's look at it some other time. So taking that first step and starting it now is important. Failing to know and manage all your risks is also very, dangerous. Please look at, what are your risk elements and are you doing enough to mitigate those risks. Failing to lead and manage, like adhering to compliance, if it is your own setup, if it is your own practice, own hospital. So just to keep looking at, compliance elements and, see that it is up to date. Failing to, it is important for any profession that matter, for any consulting professions, even for us. So we have to adhere to compliances, right? So another important is inadequate measuring of personal risks, mixing up of personal and business risks, business finances, relying on insurance alone. Most of the times we get told that I have enough insurance, so my thing is taken care. So that is a misconception. Failing to protect your income streams, thinking of alternative sources of income is as important as, you're protecting your wealth today. So future incomes also matters. Failing to use the right tools is also one mistake doctors must avoid. So that's it for our today's session. So if you have any need to consult a professional advisor, you can reach out to us. My name and number and my email ID is right there on the screen. I have been working with a lot of doctors for their retirement planning, for sorting out finances, for cleaning up of their portfolios and setting up a direction and things like that. So feel free, if you're a doctor or a medical professional, if you want to have a one-to-one chat. So we can look at having some questions now. So this is what Right Horizons does as a service. I'm just checking if I can answer some questions.
Thank you, ma'am. Thank you for sharing valuable insights. I think we are having one or two questions in the Q&A session.
Yeah, yeah.
You can take that. Meantime, I would like to request all the participants to write it down your queries or questions we are having in the Q&A section, so we can take it online.
Yeah. Sanjay, there's one question, two questions actually. So I want to start investment in stocks and mutual funds, but now market is at all-time high. So please suggest what to do and when to start my investments. So Devi, we will reach out to you separately on this. So we need to understand, why do you want to invest and how long. So based on that, we can, guide you like how do you want to design the thing. So, like I said, even if you keep investing in all-time highs, if your thing is long term, if you have a long term horizon, then it shouldn't matter.